Hey everyone, Joe here. We're here again with our Crypto Musketeers roundtable session. Sammy and Mr. T. As always, we tend to have a massive chat before these sessions. We share so much great content, so we'll make sure that we roll all of that great content and ideas into this session. I think, Tristan, we'll start with you this week. So you've just released, or you just finished, the release actually comes out, I believe, tomorrow, your project for this month. Tell us a bit high level about it, and also if you can share what you said as well before this call, where you were thinking about how to educate people and share the ideas of upcoming opportunities. Yeah, please divulge without revealing everything, so people can read it in a lot more depth tomorrow.
Yeah, sure. So I'll start on the latter points because I know a lot of people get a bit bullish once they sort of dive into some of the FAs that I do, because I do go into a bit of depth, and hopefully people get to walk away with feeling like they really understand the project. But a lot of the time, the purpose of me doing these FAs and why I select the projects that I do is that they've got, in a lot of cases, tremendous educational potential, in that if you can understand, let's say what I'm covering this week, which is Anchor, if you can understand the need for that product, the environment that product sort of is competing in, then you can make some really informed decisions when you encounter either a similar project in the future or one that has the potential to surpass something like Anchor, which is such a fundamental sort of piece of Web3 infrastructure for how blockchains and dApps work. So on the most basic level, it's more or less a decentralized network of node operators. So this differs from validator nodes. It's not like they're actually directly involved in the consensus of a particular blockchain. What they do is they provide the computational power to achieve that consensus. So a lot of different blockchains will use an Anchor node to power that process, and a lot of project owners that run protocols and Web3 services require Anchor's sort of distributed network of nodes in order to ease the sort of overconsumption of data and decentralize it so that there aren't any sort of central points of failure. So one example I'll touch on, without again going into too much detail, because I did you might see some rings under my eyes. You can call those anchors if you like. The anchors under the eyes, because I did go a bit hard on this piece, but I think it's really important to understand that and I've gone into the piece where I've touched on what are RPCs, what are APIs, what's a load balancer. So these things may seem super, super complex, to someone that may consider themselves not digital, but it'll give you quite an edge if you can understand how projects actually run. And if you can understand a project like this, then you go, oh, okay, you're starting to see the separation between Web 2 and Web 3, because it means a lot of different things to a lot of different people. It is mostly just a buzzword. It's not particularly catchy in my view, but it helps people understand that it's like the next generation of internet, where you need to, and it's an evolution of the previous, in the sense that many of the functions are still required in order to operate, let's say, a website. If you click on a website, what you're really doing is you're calling a server that runs a copy of a website that's stored locally on the server. You're downloading from that server. So so what Anchor does is effectively make sure you're downloading only what you need to, and you're not having to basically download things you don't, because that can be really, really expensive. And there are, Web3 services that run these sorts of computations as well, and they're very heavily centralized, but they don't have a way to sort of determine which data points need to be sort of frequently retrieved, because we don't need to know an entire blockchain's history. We don't need to sort of know every single transaction that's occurred. So through indexing and data caching and all these different things, Anchor are able to sort of provide a much more efficient back-end service in order for us to sort of operate on the blockchain, tinker with dApps, and do all those different kinds of things.
Yeah, and I really like the example that you give where you can just retrieve the information that you need rather than all of the information to create mass efficiencies and effectively scalability. You also mentioned, I believe, Microsoft have partnered or they're using
Yeah, so I
their
touched on
service.
them as well. Yeah, and also just I didn't mention, but it's also definitely noteworthy that BNB Chain have actually built a lot of their network with the Anchor infrastructure as well.
Mm.
So they can decentralize their endpoints. And just briefly circling back to a story I was meant to sort of just bring up while I fell down the rabbit hole as well, is there was recently, maybe about 6 months ago, we found out that the Infura RPC endpoints, they were collecting IP addresses. So what that means is, and it's a public Ethereum address, so by default, we use Infura RPC endpoints. So in simple terms, what that means is that they're able to connect your wallet address to an IP address. And that's fundamentally so against the principles of blockchain, like that it's like kind of disgusting. It's a bit gross. So Anchor are able to provide more decentralized endpoints where, the US government can't just go or, cough up your IP addresses, because many of the endpoints that are sort of private or enterprise, like they're not like mandated to actually collect those addresses. So it also brings another level of privacy in. But as for the Microsoft partnership, we would have seen the recent rally in Anchor, and I've known about Anchor for years, but it was only just sort of seeing that partnership. It came back onto my radar, and then I've sort of looked into it. I'm like, oh, okay, they're going to start using the Anchor network, like the computational nodes of the network, to support their cloud services and things like that, and also start to sort of do a bit of more bridging towards Web3. So any of the sort of Web3 and ventures that Microsoft might take in the future, they will likely, to a fair extent, leverage some of the tech that's on Anchor. And
Yeah,
like I said,
really interesting.
yeah, and it took me a long time to write. Like I said, there's lots of other things in there. They do their own SDKs and developer tools and all these other things now as well. So I'll leave it at that, and so you guys can dive in and and try your best to digest it.
Yeah, awesome. Thanks for that, Mr.
Question.
T. Yes, Sammy, go ahead.
Question for Mr. T about that. Would that have potentially stopped the US government or the Treasury coming in over Tornado Cash, the mixer? Is that kind of the technology that could stop that communication and stop that sort of people knowing where those wallets were?
Yeah, so because Tornado Cash would have been leveraging on publicly available RPC endpoints. So what an RPC endpoint is, it's like a plug. You're plugging into a blockchain basically, and it's just that the US government knew that Infura were basically custodians of this public plug. They're like, right, cop up the endpoints, and then they were able to start tracking IP addresses of people that used Tornado Cash.
Yeah.
So to prevent it, though, it would need to be like a private sort of RPC endpoint. So basically, I guess it would just kind of turn into like a bit of a whack-a-mole, because as we know, we're still wondering how the CBDCs are going to all pan out, how that's going to impact the blockchain. I've long held the thesis that basically the advent of CBDCs is going to turn traditional crypto into like the black market kind of thing. It's like, you can still transact it because they can't actually stop it, but they're going to consider it something illegal. So when it comes to Ethereum and stuff, having like a private endpoint is useful for enterprises as well. So that's another thing that actually Anchor do, is provide enterprise grade API and RPC services for like, a business that wants to build onto the blockchain, which is really cool. But in terms of being able to stop it, like I said, it's basically like a whack-a-mole, and whether they can actually they shut down whichever node might be responsible. But then with Anchor, it's a network of nodes. So you shut down one, then another one's going to assume the responsibility for that. So as long as the person so as long as the people or the person that's responsible for funding an RPC point that can host Tornado Cash, and they don't get caught by the government in a sense, then in theory, it could continue unabated.
Yeah, awesome.
Interesting stuff. Make sure you check in and read that, because that gets released tomorrow, and I think that's going to be a really interesting piece of technology for scalability and all the secure factors as well, which are just Mr. T's just outlined. So exciting project. Sammy, I'm interested to hear more about Silvergate. I know you've been talking about this with our mastermind. So tell us, because I think this has definitely been a contributing factor to the downturn that we've had in recent times. And we can talk about the Ethereum unlock coming up soon. But anything that you want to share about Silvergate in particular?
Yeah, just high level. Silvergate and Signature Bank are the two main banks in the US that are used to facilitate crypto on-ramps. So crypto to fiat, fiat to crypto, that sort of thing. So Kraken, we're kind of using them. A lot of other exchanges were using them at some point. And these are kind of like the two bodies that are still floating towards the top of the water after FTX. So there's still those second and third order effects that we're not totally free of from November last year with FTX. So both those banks were actually started as community banks, I believe. They weren't major banking institutions, and they kind of didn't know what the hell they were doing and saw the crypto revolution here. They wanted to get in on it. They made a ton of money, but they didn't have the right processes as such in place to really buffer themselves on a bank run or a massive collapse like FTX did. So they're in a bit of trouble. They've both made new all-time lows in stock price. At least that's what I saw last week. The FDIC, yeah, that's the one, is now in the offices of Signature Bank at the moment. So that's a pretty strong indication that things aren't going well. They're looking to keep the bank solvent if possible, but if not, there could be, again, more order of effects after that. So I think what we're seeing now in markets, and this is kind of my view, is the S&P 500 had a really strong move up earlier in the week, and we saw Bitcoin have a really strong move downwards. It's almost like a decorrelation or a decoupling in the moment, and we kind of saw that with FTX a while ago, where Bitcoin had kind of made probably a strong low at 17,500, and then we had FTX happen and pull us almost like an over suppression correction to the downside based on just an industry specific systemic issue. And that's what I sort of saw. And I know Tristan and I were talking about it before the session. It's kind of like the liquidity just evaporated. And that's kind of endemic of something like this happening, where the on-ramps suddenly are being constricted. And then you have something like Operation Choke Point, which is ongoing, and that's a pretty nefarious name. But again, at a high level, the SEC and government agencies are actively trying to clamp down on crypto wherever possible, and they're aiming for the choke points, where the money is going from a traditional bank account to a crypto exchange and then back again. So there's just not a lot of liquidity there. Order books are really thin, and we did have that drop. So whether we see a bounce here, I was more confident before what happened last night, where we saw yields just fly. We saw the dollar really take an uptick because the markets quite impressively have priced in overnight a 50% basis point raise in interest rates this coming decision by the Fed. So it went to 66% probability. So it's a fairly high likelihood now, and that's based on Powell's comments. So higher for longer. So the terminal rate is now, and the terminal rate means kind of the rate which they stop. That's kind of been pricing in now around about 5.8%. We're only at 4.75%. So they could do a multitude of 0.25s or a couple of 0.5s to kind of get them above, 5%, which is kind of where I think it's going to aim. They're going to get to the low fives, and they're going to see how it goes. But it's pretty clear inflation is going to be sticky. And the only way to solve this issue is to create a lot more low-cost energy, which just isn't there on the market, because we're saying they have to kill jobs right now. And that's kind of what Elizabeth Warren was grilling Powell in his Senate speech, was you want to put people out of work, don't you? You want to create 2 million people into the unemployment queue. And he kind of said, well, yeah, what do you want us to do? Walk away from our jobs of killing inflation? So they're really in this tight spot where unemployment's not going higher to trigger the recession, but we are seeing those slow metrics begin to tick over. It just seems like the recession is being pushed back. I'm very much in the camp of a lot of people are saying, soft landing, all that kind of stuff, and this time's different. I think that's just nonsense. It just seems like this one's being pushed back a little bit, and unemployment is coming. Tristan posted some great metrics in Discord around about the tech sector, who's just being hit over the head with a sledgehammer. The offloads there are pretty tremendous. But what the counterbalance to that is in the US economy is production is really ramping up. Manufacturing is being brought back from deglobalization. So there's a ton of labor jobs there, and they just need people to fill these roles. Labor is really scarce right now. So there is that counterbalance. But eventually, as people's savings dry up, these mortgages start to roll off, it's going to create a pretty vicious recession. I'm just not buying it. And that's shown in the yield curve inversion, which has never failed. And I know even the creator of it saying this time's different. I just feel that is a bit of traditional financial hopium to make stocks pump. Sorry, I went on a bit of a tangent there, but that's kind of the series of events that I'm seeing. And we also had a bit of a red herring pop up this morning, which was Grayscale, the largest owner of, public owner of Bitcoin. I could be wrong there. Maybe Sailor is at the moment. I thought Grayscale was, but
no, I think it's Grayscale.
Yeah, they are the public trust in the US, which holds a ton of Bitcoin. Now we know that their price of their shares is tremendously discounted to the actual NAV, the Bitcoin price, and people kind of want out. Now, they've been trying to convert to a Bitcoin ETF, a spot ETF, for a very long time, and the SEC, Gary Gensler, has been like, no, whacked away every single time, just doesn't want to approve a spot ETF. So Grayscale took the SEC to court, and today that started. And a lot of mainstream commentators in this sort of space, and also in the lawyering field, are saying that Grayscale really look good here, and the markets are actually pricing in a 70% chance now that Grayscale is now going to convert to a spot ETF. That the court is going to enforce this, that it was unfair, and they're going to do this. But that isn't necessarily a good thing right off the bat, because that allows investors that have shares in this trust to get the equivalent of their shares in Bitcoin in their hands, and they can sell it if they want on the open market, or they can force the trust to sell it and they'll get cash in their hands. So there was kind of a bit of a dump this morning as well on some more news. So look, in my eyes, all this stuff could be just construed as noise if you're a longer term investor. And for me, it kind of is, because when we look at it, we moved up to 25,000. If we couldn't break through it, we were coming back to test support at lower levels. And that's kind of what we're doing. The 200-day moving average for me is kind of the point that I'm interested in, which is around 20,000, between that and 20,500. I want to see the reaction there. And if bulls do not turn up at that point, then I reckon you might be right, Tristan. We're probably heading back to the lows. But I do think the lower 20,000s it's going to be a pretty tough area to break. And we might need a catalyst, like a credit market freeze up, or something in traditional finance that sends us a bit lower. But again, lots of moving balls in the air at the moment. Hard to pin down what's going on, apart from you see the dynamic of the dollar moving higher and the yields moving higher. It could be just as simple as that. But there's a lot of industry-specific negative news that, no doubt in my mind, has contributed to Bitcoin's weakness here. And that's my read.
Awesome. Thanks, Sammy. I think based on what Sammy's saying as well, that we've spoken about the ranges of the 25K down to that kind of 21K region where the 200 moving averages on the daily. That seems the range that we are bound between. We potentially may lose that and go to the downside, like Mr. T said. But that is the strong range that we're in between right now. If we weren't able to break that leading into the inflation announcement on the 14th, which looks very unlikely at this stage, then we have to expect that we're going to see these lower levels. All the added negative news certainly hasn't helped us by any means, but the chart is definitely not looking strong at all here. There's clearly a downward path through here.
A head and shoulders potentially developing there as well.
Yeah, and we've broken through the 50, so it's likely that we're coming to test that 200. RSI is certainly trailing off, looking very, very weak.
That divergence played out like a treat, didn't it? Look at that, 2 peaks higher than the last, and then the RSI trailing off as well. I was looking at that, and it's just like far out. They don't really miss on the daily, do they?
No.
I'll probably say on like the flip side, the positive side, short-term stuff. The markets now, because of the dollar, the yields, all that, S&P 500 and Bitcoin, they're now all trying desperately to price in this 0.5 rate rise. if that doesn't happen, if it's a 0.25, yeah, we might see a rally. But regardless, it's trying now to do the Fed's job for them. It's trying to tighten market the conditions in the market. And so there likely comes a point, as we saw multiple times in January and also last year, where the news is leaked, markets price into the downside, then we hit support and we start to grind higher again in a nice sort of higher low fashion. That's my hope here. But again, play it level by level and go from there. Yeah, we wouldn't want to lose that 21,000, that horizontal there. That would be pretty bad. But,
and for anyone that was listening in, Sam spoke about a divergence. So this is the RSI, it's the strength of the market. If you see the price is going up, but the strength of the move is going down, that is called it's basically a negative divergence. And we expect there to be a move downwards afterwards, exactly like that was. So that was really on the money, with that call. And it's very, very clear. We do have this as part of our VIP immersion course as one of the investment strategies as well. So certainly worth looking into if you are a member, because we just updated a number of our videos in the series too. Let's touch on Ethereum as well. So Ethereum have Shanghai coming out, which means that people are able to unlock some of their staked Ethereum. Tristan was sharing two sides of the arguments, and Mr. T, why don't you bring up some insight on that and just share your thoughts as to what you're seeing?
Yeah, so I think we have to take into consideration the broader macro that sort of Scoop just alluded to then, where there's those two sides of the argument. So I think the unexpected outcome is less likely to occur, whereby we actually see a pretty strong rally on the unlock. And the reason why we may have seen a strong rally on the unlock is that not only are people being able to unlock their Ethereum stake and their rewards, but they're also able to actually restake and for new stakers to come in. So people could potentially, want to purchase Ethereum and then go, I'm not across the staking terms, but they may then want to go and stake that. Whether that's locked or not, I'm not entirely sure. Or if there's a bonding or unbonding period, that would be something that would warrant a bit more research. But the idea is that people are going to unlock and unstake their rewards, and they're just going to go ahead and dump it. And then the other side, which is the argument which, we could be hopeful for, but based on the macro sort of elements that Scoops has touched on now, it doesn't seem likely to me that we're going to have liquidity or retail liquidity flood in and want to obtain Ethereum to then go and stake. What's more likely is that people that already have decent sized bags of Ethereum may go ahead and actually stake, like once they're able to with the unlock. But I would expect that there's going to be a bit of volatility following this Shanghai upgrade, which will allow people to access their staked rewards. And unless we see some changes with the upcoming macro events that Joe just had up on the calendar earlier, because we do have the actual interest rate decision, and we have in a couple of weeks, I think. And thank you. Got like the balance of trade tomorrow, so imports, exports, and we'll have the core inflation rates next Tuesday, which may be Monday our time, I think, about 12:30 a.m. I've actually got a list in front of me. Sorry, guys, but it's worth repeating just for those that aren't in the MMs, because the masterminds are fully across this. They've got this locked in their calendars, but 12:30 a.m. Australian Eastern Daylight Time tonight we'll have the balance of trade. Then we'll have jobless claims same time the next day on Friday. Then we'll get the official unemployment rates, which for the reasons that Scoop just sort of touched on, that right now the Fed are trying to basically demolish jobs, trying to create unemployment to push us closer towards a pivot, which would, I guess, discredit this soft landing notion, as we do tend to observe that when the Fed pivots months later, we often reach a place where we go, okay, we're in a recession. And then, next Tuesday, the inflation rate, then PPI, which is often quite important because they're pricing in the effects of inflation on consumer goods and all those different kinds of things. So over the next sort of 1.5 to 2 weeks, or the next, I guess over the next week or so, we will have more data coming out, which could be a catalyst to the S&P, and we may get some contagion into Bitcoin. But right now, the liquidity situation is not too great. And the broader sort of, there's also a lot of, we haven't even touched on it, but there's quite a bit of rhetoric around, the UK effectively just announced that they should go to war with Russia. So like in terms of them actually put their soldiers on the ground there. So,
Okay.
that's obviously, that doesn't inspire confidence sort of in any sort of risk on markets when there's all sorts of really intense sort of macro stuff going on. That was from the defense secretary that had said that as well. So he's basically like, he wouldn't be saying that stuff unless he's really trying to gear up that outcome, which would, not be great for risk on markets. And we just need to sort of recall what happened when the conflict initially started about almost a year ago now. That was when ACCUS completely erased any notion of it was going to be a bull market. As soon as that happened, we got a dump. All of us at CCR were like, yeah, okay, we're in a bear market now. We're like, oh no, we might get a bounce, and we just lost key levels on the higher time frames, and we went, okay, get comfortable, we're in a bear market. So I'm not too sure. It's the timing of a lot of things do appear interesting. So, and as Joe said, and Sam said as well, I do favor that we're going to revisit the macro lows, both from a macro perspective and from the technicals. I've been playing with harmonics lately, and I mean, I could see a pullback to 18,000 based on the harmonics on a high time frame, and they're generally pretty reliable in confluence with other indicators as well. In the short term, like we say, there's so much volatility. The swing momentum indicators are sort of flashing bullish, but right now, like we say, it doesn't matter how great your indicator is if there isn't the liquidity to actually drive it home. So yeah, that's kind of where I'm at, I guess, on the market more broadly speaking at the moment. Macro with the poor sort of, like on the technicals, it should be worth noting as well before I shut up is that, we are still in bullish market structure on like the weekly, in recent sort of weekly candles that have come out. So it's not all over but the crying just yet. But as Scoop and Joe just alluded to, if we lose 21,500, 20K's next, we lose 20K, then 18K's all but written in. So yeah, I would say just for what everyone else is doing, just continuing to your dollar cost averaging strategies is the way to go. I'm definitely way too scared to be making any sort of short-term plays right now until we get a bit more certainty out of potential catalysts, from the like US government figures that might come out that might push us in another direction. But I still think that there's a bit of pain to come.
Yeah, nice, Mr. T. And I completely agree. Whilst all of this stuff's going on, it's high risk to be involved in the market. The lower the risk you are, the more that you're willing to wait until we see the back end of at least the interest rate rise, maybe even some of these latest stats as well. So yeah, interesting to see how this all plays out. It looks like the market is flipping to that 0.5. And we just got to be mindful of it as an investor. Protect your downside if you are in the market, and look to capitalize on the upside as well, in case there is a move out of here. And that's it. Capital conservation to really then go on to capitalize as much as you can in the upswing of the market rather than playing with fire when you don't need to. Nice. Anything else that you wanted to add before we close out this session? I think we've covered off most of the key topics that we wanted to share.
I think we've scared everyone enough. Just keep up your dollar cost averaging, guys. If we hit 18K Bitcoin, you want to be a buyer there for sure. And remember, buy the fear when everyone else is fearful. Get greedy when everyone's greedy. Get fearful. To sort of keep those basic tenets in mind. But as I've said to the masterminds, this is the year where both bulls and bears will get wrecked. So trying to find some nice middle ground where you're just in accumulation mode. That's the way to go in my view.
And Tristan, do you want to share anything about what you're doing with the NFT stuff, with property at the minute and potentially gold as well?
Oh, sure. I mean, just out of interest for everyone, so while obviously, put a lot of work in with the masterminds and into the newsletter. On the side, I'm also doing pursuing tokenizing property developments and property options. We've actually got into a joint venture with a company in Brisbane. So we're on the tail end of that development now, and we're looking forward to getting some of their clients to run their developments and properties through the protocol. So that's another angle that we're looking at. And also Joe mentioned tokenizing gold and things like that as well. We're currently exploring that, so we're definitely still in discovery there. Fortunately, I've got far smarter people than I when it comes to the commodity side of things that is able to sort of wrap their head around that a little more. But yeah, I guess, and just circling back to the kinds of things that we should be looking at, and this is where Anchor is a good example as well, is that you want to be looking probably for these projects that are seeking to sort of generate revenue. Like, it is a bear market. So, those sorts of ways to hedge your bets when you're looking for those kinds of projects. Not saying invest in mine, just simply saying that, as we sort of navigate through the market, we want to be keeping an eye on these sorts of projects that are able to generate revenue, that are inherently crypto or Web3 projects, but they're able to sort of pull that real world revenue. And hopefully we'll get really good outcomes when we tokenize property developments, options, and hopefully gold.
Nice, very exciting, mate. I think with crypto, you really have to look into the future rather than the short term when there is volatility, which is very easy to do. Sammy, Litecoin is currently in our top 10 portfolio still, isn't it?
Yes, it is.
Do you want to mention anything? Obviously, you've got your thoughts on it, but what Matt was saying around it in terms of performance based in the chat that we had?
Yes, so I've been a little bit bullish on Litecoin for a little while, and that's basically around the halving event that's going to happen in August. It has traditionally preceded Bitcoin's halving and has run really strongly into that. And even when it hasn't maybe, just shot to the moon, it's just held relative strength. So it's a decent play to have towards the back end of the year, or just to look at. And again, it's kind of like a mirror image of what Bitcoin does, but Bitcoin does it on a much, much larger scale. It just depends if Litecoin still has the buy-in, but it has a nice narrative and whatnot. But I think what we need to maybe mention here is, if you're looking to play the Litecoin narrative, and it's why it's in our portfolio, it's got a limited supply as well, and it's proof of work crypto, so regulatory issues are lessened in that respect. But if you are looking at it, try and think in terms of front running the market a little bit, because the halving will happen at, say August, I think it is. And I think Matt was saying how they got, when he was the funders at Digital X, he was getting wrecked from shorting it, constantly shorting it, thinking it was going to fall over. I never did. But this year is much, much different. There's a lot less liquidity, a lot less interest in the market. So if you are playing that, you almost have to get in front of that halving by a significant margin. So I would probably expect a bit of a run up around June or whatnot. But yeah, it's pretty fascinating. You try and short a narrative, even as a big fund, and it can get you absolutely wrecked. And it shows you the power of sort of looking ahead, using coin market calendar. If you have any interesting investment and you have a strong fundamental catalyst in the future, it's like Illuvium right now. You see it had a massive run up off the low, like a lot of things, and it had a catalyst happen this week. Matic as well has had an absolutely incredible back end of 2022 and amazing 2023. It's had a shocking last couple of weeks, but into that, and it kind of like the ZK, I think, rollout of their network. Tristan, you'll butcher me for my explanation there. But we've really pretty much sold off at the beginning of this month, when ZK, I think, was towards the back end. So the traders, speculators and whatnot, investors are all front running, selling it, well, almost a full month beforehand, where you're expecting, it's going to keep going, it's going to keep going all the way to the event. So you just have to be a bit careful and manage your risk a bit more with some stop losses and take some profit off the table.
Very good, mate.
Just to add, I mean, sorry to interrupt. I was just going to say, add to that, it sort of goes to show that, you can sort of, you can definitely make a play on fundamentals, but sort of what I always sort of bring it back to is that during a bear market, the technicals are often more important than the fundamentals. So, if people are able to sort of make that profit off the ZK narrative through, as Polygon's sort of been rolling it out, many of these investors are in like pretty decent profit. So at some point we need to expect that that's going to be taken off the table. And because we're not in a bull market, we're not just getting like irrational levels of liquidity, just making everything, like, I hate using the word, but go to the moon. Like everything doesn't just moonshot just because it's a bull market. Like, there is a lot more sort of tangible sort of risk taking, and it sort of goes against what you think might happen in a fundamental play. So yeah, something just to keep in mind and manage your risk, I guess, when it comes to those types of things. But definitely like participate. Like, we were talking with the masterminds on the AI sort of narrative coming up. We come across ChatGPT, went, yep, cool, all right, you guys need to start looking for AI cryptos. And then like between January 6th to February 8th, AGIX was up like 1,000%. So like you can definitely play the fundamentals, but like got to be prepared to be really aggressive with profit taking in those instances, because it's not going to go up forever in a bear market.
Absolutely. Awesome. I think we'll wrap it up there, gang. Really appreciate your time. Thanks for everyone that's tuning in and watching this as well. If for whatever reason you're not a newsletter subscriber, make sure you sign up, because we share so much insight and content in those sessions. And thanks for all the work that you boys do. It's incredible. So yeah, really appreciate that, and appreciate all of you for reading and watching all of our content. It makes us keep going and keep ticking and keep moving in the right direction and keep improving as well. Awesome. Over and out, gang.